This is Bart Kellerman, and welcome to Battle of the Quants TV. We're actually live at the Battle of the Quants at the Mayfair Hotel in London, England. It's July 16th, 2011, and we're having a great time here at the Battle of the Quants, exploring new quantitative technologies and ideas for quantitative investors, traders, and those who provide technical expertise to the quant world. Joining me right now is Kevin John Coogan, who's a managing director at AmalgaMood. The first thing that strikes me is the name. It sounds a little bit 70s, AmalgaMood, you know,
Yes.
mood rings.
Yes.
Tell us a little bit more about what exactly your company does.
Okay. Well, we try to amalgamate the information on the internet, time-stamped information, text information on the internet, which would include social media, blogs, Twitter, as well as news. And we try to aggregate that into a social mood index, which has predictive abilities for the stock market.
Very, very interesting. It's interesting because what I've seen is there are more siloed type of approaches. You have the Twitter approach, you have the blog approach from Japan, and then you have, I guess, AmalgaMood, which is your company, which then combines all of them, which I assume would give you even more valuable information.
Yes.
But what is the time sequence on that?
Exactly. Okay. There appears to be, right now, two different types of analysis. One would be a type of intraday arbitrage, where you get news into your system quicker than anybody else, and your automated trading system can take those trades. The second type is a multi-day approach, where your holding periods would be approximately 3 or 4 days. What we're trying to develop is an automated system that reads these the internet text and makes forecasts going out approximately 6 months to 18 months. So the holding period would be much more along the lines of what traditional investors have. They want to know if we're heading into a bear market, if the current bull market will continue, that kind of thing. The high frequency data strategies are very interesting for quantitative hedge funds, but not as much for the general investor or for the financial media.
Okay, I'm sure a lot of people are watching this and they're asking me, you know, ask him, ask John or Kevin, what is your model saying? I mean, what are we looking at 6 months to 12 months down the road?
Normally these signals give about 6 to 18 months trending calls. The last call was a negative call. Currently the social mood index is heading down since February 25th, 2011. And since then, the global stock markets have felt it. There's been a strong weight on performance. So if you would have seen this at the end of February, a normal investor or even a hedge fund would have known to either get more neutral in equities or even go short.
Okay, that sounds very interesting. Now, it sounds like you're doing a lot of research, a lot of analysis, and it looks like it's paying off based on the actual, you know, results of what you're doing. But is this a fund that's investable, or are you going to launch a fund? What are you going to do with all this great data? We
are currently looking into launching a fund.
Okay.
So I'll keep you informed, Bart.
Please do.
Thank you very much.
Okay, Kevin, I really appreciate that. And thank you for your time. That was very good. Appreciate it. This is Bart Kellerman reporting from the Battle of the Quants, June 16th, 2011, London, Mayfair Hotel. We'll see you in Hong Kong, December 1st. Thank you very much.